Imagine a top-tier surgeon, someone who has spent a decade in training and now works under immense pressure to earn a living. For a professional at this level, a $500,000 salary is taxed as earned income, triggering a federal rate that climbs as high as 37%. But when an investor generates that same $500,000 by selling stock, it's a long-term capital gain, capped at just 20%. Identical dollar amounts yield radically different burdens. The system taxes working nearly double the rate it taxes owning. Warren Buffett famously highlighted this disparity, noting he pays a lower effective tax rate than his secretary because his income stems from investments. To see how this gap widens into a chasm, we have to look at the four pillars of the modern tax system: rate arbitrage, deferral, the liquidity loophole, and the terminal reset. These provisions aren't accidental flaws. They are the calculated output of a code engineered to prioritize the growth of capital over the value of labor. The system begins with a baseline distinction between earned income, what you get for your time, and capital gains, what you get for your assets. This creates opportunities for carried interest, a specific provision used by private equity and hedge fund managers to bypass ordinary income rates. These executives charge a 20% performance fee on the profits they generate. Even though this is compensation for their professional labor, the tax code allows them to classify it as a capital gain. This allows a hedge fund manager making $50 million a year to pay a lower effective tax rate than a nurse or an accountant earning $80,000. The payroll tax system further inverts the burden. For a worker earning $70,000, Social Security and Medicare taxes apply to every single dollar. However, for a CEO earning $5 million, these taxes cease once they cross the yearly cap of roughly $168,000. The effective rate of this tax actually drops as income moves into the millions, making it a regressive feature of the code. Even at this basic level, the fundamental math of the system imposes a higher relative cost on wages than it does on extreme wealth. In wealth preservation, the most important rule is that unrealized gains are protected. As long as you don't sell the asset, you don't owe tax. Real estate investors maximize this through depreciation, a mechanism that separates the actual value of a building from its value on paper. This creates a counterintuitive outcome. An investor collects millions in rent while the building's value climbs, yet claims a paper loss, wiping out taxable income. Strategies like cost segregation front-load deductions, creating massive year-one losses that offset other income. When it is time to sell, the 1031 exchange allows the investor to swap profits into a new property, deferring the tax bill indefinitely. Provisions like opportunity zones extend this even further, allowing investors to lock in capital for a decade to make future profits entirely tax-exempt. This perpetual deferral functions as a compounding wealth generation engine, where money that would have gone to taxes stays invested and growing. For those with the right assets, delaying a tax bill forever is mathematically the same as never having to pay it. This raises an obvious question. If a billionaire never sells their $500 million stock portfolio to avoid taxes, how do they get the cash to buy mansions and private jets? In the buy, borrow, die strategy, wealthy investors use shares as collateral for bank loans instead of selling them. Because debt is an income, this cash is tax-free. Meanwhile, the underlying stock continues growing, often outpacing the loan's interest. This maneuver creates a closed loop where the ultra-wealthy can access unlimited liquidity while remaining completely outside the standard income tax system. It provides more spending power than the highest corporate salaries, but without the burden of income or payroll taxes. By decoupling cash flow from asset sales, the system effectively makes the income tax an optional contribution for the ultra-wealthy. High-earning professionals, like doctors and consultants, often shield their income through entity wrappers rather than direct ownership. A common tactic involves the S corporation, which allows a business owner to reclassify their earnings to avoid the 15.3% self-employment tax. If a business earns $800,000, the owner might pay themselves a reasonable salary of $100,000, while taking the remaining $700,000 as a distribution. That larger portion bypasses the payroll tax entirely. Charitable giving is also used as a sophisticated tax reduction tool, most notably through donor-advised funds. Contributing $10 million in appreciated stock to a fund grants the donor an immediate tax deduction and erases the capital gains tax, all while they retain control over how the money is eventually spent. Geographic arbitrage allows the wealthy to physically move their residency or corporate profits to more favorable jurisdictions. By moving to places like Puerto Rico, investors can lock in a 0% capital gains rate, a move that has become standard practice for crypto billionaires and hedge fund managers. This network of trusts, corporations, and offshore accounts isn't an obstacle, it's a deliberate moat. The complexity itself is what makes the wealth impenetrable to taxation. What happens to the billionaire who spent a lifetime living on tax-free loans while their assets compounded? When they die, does the bill come due? The final mechanism for dynastic wealth preservation is a provision known as the stepped-up basis. Consider an asset bought for $1 million in 1970, worth $200 million today. Normally, this represents a $199 million taxable gain. But at inheritance, the cost basis steps up to market value. The historic gains are legally erased. This ensures that decades of compounding wealth are passed down without the tax system ever touching the growth that occurred during the original owner's life. This single reset button costs the U.S. government an estimated $40 to $50 billion every single year in foregone revenue. Death serves as the master reset switch, turning a lifetime of temporary tax deferral into permanent wealth elimination for the state. We see two distinct paths for capital. On the left, the narrow, heavily taxed line of W-2 labor. On the right, a sprawling circuit board of deferred liabilities. Labor is locked into a high-friction pathway, while capital flows unimpeded through a frictionless circuit. Every one of these mechanisms exists because a specific interest group lobbied for its inclusion. From real estate groups protecting depreciation to private equity protecting carried interest, the code is a mirror of political influence. For the middle class, the tax code is simple, ensuring they pay the maximum rate. For the wealthy, the code is complex, ensuring they pay the minimum. None of this is hidden or illegal. It is the system operating exactly as it was designed, documented in thousands of pages of federal law. Understanding the mechanics of this architecture is the first step toward deciding if this is the system we actually want to sustain.